5 million people walk into a Walmart store in Mexico every day, making it the most successful international operation of the entire corporation. But in Brazil, the largest market in Latin America, that same giant lost billions of dollars and ended up fleeing the country with a destroyed brand. Same continent, same company, same decade of entry, completely opposite results. Today, I'll tell you why Walmart conquered Mexico and failed in Brazil, and the lesson this leaves for any business that wants to expand. If you like business stories, hit like, subscribe, and comment on which other case you want us to analyze so this channel keeps growing. The Latin American Conquest. To understand this story, we have to travel to the 90s, when Walmart already dominated the United States and its executives were looking at the map searching for the next territory to conquer. The strategy was simple and aggressive. Enter emerging markets with all their financial power, replicate the formula that had made them giants, and crush the local competition. Europe, Asia, Latin America. Walmart wanted to be everywhere. And Latin America seemed like the perfect territory. Growing economies, expanding middle class, consumers hungry for better prices, and millions of people who had never set foot in a modern hypermarket. But here's where it gets interesting, and I want you to think about this before continuing. If you were a Walmart executive at that time, would you enter Mexico or Brazil first? Pause the video and leave it in the comments, because the answer you choose says a lot about how you think about business. Mexico had almost 90 million inhabitants and shared a border with the United States. Brazil exceeded 150 million and was the largest economy in the entire region. Both markets seemed like gold mines waiting to be exploited, and Walmart decided to enter both almost at the same time, in 1991 to Mexico and in 1995 to Brazil. But here's the mistake they made, the same mistake many companies still make today. Thinking that Latin America is a single homogeneous block, believing that what works in one country will automatically work in the neighboring one just because they share a language or continent. That assumption cost Walmart billions of dollars. What you're going to see in this video is not just the story of a corporate expansion. It's a lesson about strategic adaptation that applies to any business, regardless of its size. Mexico, the smart move. When Walmart arrived in Mexico in 1991, they did something that almost no multinational did at that time. They accepted that they didn't know everything. Instead of arriving and imposing their American model as if it were the only correct way to do things, the executives made a decision that would change the company's destiny in the country. They partnered with Cifra, the Mexican group that owned Aurrera and other chains that had spent decades understanding the local consumer. That alliance was not just a commercial agreement, it was a declaration of strategic humility. And here's something many entrepreneurs don't understand. Sometimes the smartest move isn't to prove you're the strongest, but to recognize that you need to learn. Walmart spent years observing how Mexicans shopped, what products they were looking for, how much they were willing to pay, and how often they visited stores. They didn't rush to expand. First, they understood the terrain. What they discovered was revealing. The Mexican consumer didn't shop the same way as the American one. While in the United States, people made one big purchase every week or every 2 weeks, in Mexico, families preferred smaller and more frequent purchases. Price was the decisive factor, but not just any price. It had to be a price the customer could verify by comparing with the corner store. With this information, Walmart didn't try to educate the market or change consumer habits. They simply adapted. That's when the expansion of Bodega Aurrera was born, a format designed specifically for the Mexican wallet. Smaller stores, bulk products, local brands on the shelves, and an obsession with maintaining the lowest prices in the market. Walmart integrated thousands of Mexican suppliers into their supply chain, which not only reduced logistics costs, but also generated goodwill with the government and communities. Every decision was made with a single objective: to make the Mexican customer feel that the store was theirs, not that of a foreign corporation. The expansion was progressive and calculated.
They didn't open hundreds of stores all at once, hoping that volume would solve the problems. They consolidated one region before moving to the next, learning from each local market within the country itself. The result of that strategy is visible to everyone. Today, Walmart operates more than 3,200 stores in Mexico, with a presence throughout the national territory. 5 million customers cross their doors every day, and the company continues to invest billions of dollars in new openings and technology. Walmart didn't conquer Mexico as an invader. It conquered it by becoming Mexican.
The cultural factor, why it worked. There's something that numbers and corporate strategies don't always capture, and that's the consumer mindset. In Mexico, saving isn't just a preference, it's almost a philosophy of life. Mexican families learned during decades of economic crises, devaluations, and inflation that every peso counts, and that wasting money can mean the difference between making it to the end of the month or not. Walmart understood this in a way that its foreign competitors never did. While other chains tried to sell the shopping experience, the nice aisles, and the premium brands, Walmart focused on a single promise: here you pay less. And they kept that promise every day, not just in special offers or discount seasons. The Mexican consumer could walk into Bodega Aurrera any Tuesday of the month and confirm that the prices were still the lowest. That consistency generated something that money can't buy: trust. The frequency of purchase also worked in Walmart's favor. Since Mexicans visit the supermarket several times a week instead of just once, every visit was an opportunity to reinforce the relationship with the customer. More visits meant more touchpoints, more loyalty, and more sales opportunities. The volume strategy worked perfectly with this behavior. And here's the fundamental difference between success and failure in international markets. One thing is to export your business model expecting the customer to adapt to you, and quite another is to adapt your model to the customer. Walmart didn't come to Mexico to sell the American dream, they came to sell daily savings.
Brazil, the same giant, another result. Now, I want you to do a mental exercise. Imagine you're a Walmart executive in 1995. You've just entered Mexico with a cautious strategy and things are going well. You look south and see Brazil, 200 million inhabitants, the largest economy in Latin America, a market that is practically begging you to enter. You have all the money in the world to invest. What would you do differently? Think about it for a second, because what Walmart decided to do will surprise you. They entered with the same arrogance that had worked for them in other markets. But Brazil was not just any country. Carrefour, the French retail giant, had been consolidated for years and was billing $14 billion annually. Pão de Açúcar, the local leader, dominated with $25 billion in sales. And Walmart arrived thinking that their brand and financial power would be enough to steamroll everyone. Between 2004 and 2005, they spent $1.257 billion buying 258 stores all at once. Overnight, they went from nothing to operating 550 stores in 17 of Brazil's 26 states. Sounds impressive, but this is where the disaster began. The stores they bought were in terrible locations, one-way streets, hard-to-access areas, places where customers simply didn't want to go. Walmart never managed to generate the traffic needed to make those locations profitable, and each store became a black hole that consumed money. But the most serious problem wasn't logistical, it was cultural. In Brazil, there were 200 million active loyalty cards, a system where consumers accumulated points and benefits for always shopping at the same chain. Carrefour and local competitors dominated this game. Walmart didn't even try to compete in that arena. And here comes the data point that summarizes the entire failure. After investing billions of dollars over more than 2 decades, Walmart's market share in Brazil never exceeded 2.5%. Read that number again. 2.5%. The largest retailer on the planet, with virtually unlimited resources, couldn't conquer even 3% of a market where its competitors tripled them in sales. Brazil was not Mexico. The rules were different, the consumers were different, the competition was different. And Walmart took too long to understand that.
Years of loss and retreat. What came next was a slow and painful agony. 7 consecutive years of operating losses. 7 years where every financial report confirmed what everyone already knew. Brazil was swallowing Walmart.
The margins were so weak that every store operated practically at zero or in the red. Logistics was chaos because the country has continental dimensions, and Walmart never managed to build an efficient distribution network. There were internal restructurings, changes of executives, new strategies that promised to turn the situation around, and nothing worked. In 2018, Walmart finally accepted defeat. They sold 80% of their Brazilian operation to the investment fund Advent International and recorded an accounting loss of $4.5 billion. Let me repeat that figure because it's hard to process. $4.5 billion lost in a single move. That's more than the value of many entire companies. The operation changed its name to Grupo Big, and the Walmart brand began to disappear from Brazilian stores. 3 years later, in 2021, Carrefour Brazil bought all of Grupo Big. The same competitor that Walmart had tried to defeat for decades ended up keeping the remains of their failure. By 2022, the Walmart name no longer existed in Brazil. 26 years of operation, billions invested, and in the end, nothing. There's a brutal lesson in this story that many entrepreneurs refuse to accept. Sometimes the best strategy is not to persist, not to invest more money, not to change directors. Sometimes the best strategy is to exit. Argentina, silent retreat. And if you think Brazil was the only disaster, let me tell you what happened in Argentina. Because the pattern repeats itself, but with an extra ingredient, a country in permanent crisis. Walmart operated 92 stores with more than 9,000 employees. It was the 9th largest private employer in the country. But in November 2020, they sold everything to Grupo de Narváez for just $44 million. Question for you, how much do you think Walmart lost on this operation? The answer is in the document they sent to the New York Stock Exchange, $1 billion in losses, mainly due to the brutal devaluation of the Argentine peso. The context was impossible. 37% annual inflation, currency controls that prevented taking dollars out of the country, prices frozen by the government while costs rose out of control, and an economy in recession since 2018. Walmart wasn't alone in fleeing. Falabella, LATAM Airlines, Axela, and dozens of multinationals escaped at the same time. But beyond Argentina, there was a global strategic decision. Walmart was concentrating resources to fight Amazon in the United States and simply couldn't keep bleeding in complicated markets. The logic changed completely. It was no longer about being everywhere, but about dominating where they could really win.
Chile, the strategic stronghold. But then, where did Walmart work in South America? The answer is Chile, and the numbers prove it. 403 stores operating nationwide, 20% market share, and a recently announced investment of $1.3 billion through 2029 to open 70 more stores and create 4,000 direct jobs. While Walmart was fleeing from Brazil and Argentina, in Chile, they were doubling down. Why Chile and not the others? Think about it for a moment. Chile has the most stable economy in the region, controlled inflation, clear rules for business, and a consumer with predictable purchasing power. There are no surprise currency controls or price freezes by decree. Walmart can plan 5 years ahead without fear of the government changing the rules of the game overnight. Additionally, the market is more manageable. 18 million inhabitants versus 200 million in Brazil. Less logistical complexity, fewer regional differences, more control over operations. The lesson here is simple but powerful. It's not about being everywhere, it's about being where you have a real advantage. Direct comparison, Mexico versus Brazil. Now I want you to see the numbers side by side, because the difference is brutal. In Mexico, Walmart operates more than 3,200 stores, has 5 million daily customers, and just invested 34.5 billion pesos in Mexico in 2024 alone. In Brazil, after investing billions over 26 years, they ended up with 2.5% market share, sold everything, and recorded losses of $4.5 billion. Same giant, opposite results. What did they do differently in each country? In Mexico, Walmart entered in 1991 hand-in-hand with Cifra, a local partner who knew the Mexican consumer better than anyone. They spent years learning before expanding. They created Bodega Aurrera specifically for the working-class wallet. They integrated local suppliers and adapted every product, every price, every format to what the customer really needed. Growth was progressive and calculated. In Brazil, they did exactly the opposite. They entered in 1995 thinking that the size of the market guaranteed success.
They spent $1.257 billion buying 258 stores all at once without analyzing the locations. They never understood the loyalty card system that dominated the market. They competed against Carrefour and Pão de Açúcar, giants that had been consolidated for decades, and the logistics of a country with continental dimensions crushed them. If you had to summarize this story in a single sentence, it would be this: Walmart won where it took the time to listen to the market, and it lost where it assumed it already knew all the answers.
Business lessons. If you made it this far, I want to leave you with 6 lessons you can apply to any business, regardless of its size. First lesson: Latin America is not a uniform block. What works in Mexico doesn't work in Brazil, and what works in Brazil doesn't work in Argentina. Each country has its own consumer culture, its own rules, and its own competitors. Treating the region as a single market is the first step toward failure. Second lesson: market size doesn't guarantee profitability. Brazil has 200 million inhabitants, and Walmart never exceeded 2.5% market share. Big numbers on paper can turn into massive losses in reality. Third lesson: cultural adaptation is a brutal competitive advantage. Bodega Aurrerá exists because Walmart understood how Mexicans shop. In Brazil, they never created anything equivalent. Fourth lesson: logistics can destroy your margins. A country with continental dimensions requires infrastructure that takes decades to build. Walmart underestimated it and paid the price. Fifth lesson: retreating is also a strategy. Selling Brazil and Argentina wasn't defeat, it was intelligence. That money is now invested in markets where Walmart can really win. Sixth lesson: not all victories can be replicated. Success in one place doesn't give you automatic right to success in another. Each market demands humility and starting from scratch. Now let's go back to the beginning. More than 3,200 stores in Mexico, 5 million daily customers, investments of billions every year. In Brazil, $4.5 billion lost, the brand erased from the map, and the remains of the operation sold to their biggest competitor. Same giant, same ambition, completely opposite results. The conclusion is simple but powerful. In global business, the biggest doesn't win. The one with the most money doesn't win. The one who arrives first doesn't win. The one who best understands where they stand wins. If this analysis added value for you, subscribe to the channel, hit the bell, and leave me in the comments what other business story you want us to analyze. See you in the next video.